Valens Research, Uniform Financial Analytics.
McKesson is super interesting because as a, if you will, drug distribution company at the end of the day, its business and distribution of a lot of things other than drugs also, but drug distribution, equipment distribution, supply distribution for healthcare professionals. It is a high turns business, meaning they don't have a very big margin. Instead of having a very big margin, they have phenomenal asset turnover, meaning inventory doesn't stay on their balance sheet for long. It comes in, it goes out, it comes in, it goes out. And what they don't have in terms of pricing power, they certainly have, right? I mean, this is a company that the uniform accounting margins for this business are sub 1% right now. And they've never been above 2%, right? Even Ebitda margins, as reported Ebitda margins for this company, are basically 2%. If you look at most companies and you saw a 2% Ebitda margin, your eyes would bug out of your head and you'd say, we need to short this company to the ground. It's never going to make money. For McKesson, their game isn't high profitability in terms of margins. It's a low margin business that can turn over its assets rapidly. And we can see that when we look at the uniform accounting asset turnover, right? For this company, what's really interesting is you look at the margins of this business and you'd say, uh-oh, McKesson's profitability is breaking down. That's concerning. In reality, what's gone on is McKesson has just actually given up pricing and made up for it by boosting its asset turns even faster, right? Asset turnover has gone from I turn over my whole entire balance sheet once a year. I mean, once a month, 12 times a year, right? For every dollar of revenue I generate, right? For every dollar of assets that I have in my balance sheet, I generate $12 of revenue. To now it turns it over 18 times a year. So every basically 3 weeks, McKesson basically turns over its whole entire asset base and turns it into revenue. That's phenomenal, right? And that's how you got a company that has, basically 20% returns. And even though they legged down in 2019 to 16% returns, that's how you have a company that has returns that high with a 1% margin level. Right, but what's so important about McKesson and so powerful is the as reported metrics don't just misrepresent McKesson's returns, they also straight up misrepresent McKesson's profitability in terms of EPS. If you looked at McKesson, you'd be looking at a company with an EPS of 17 cents on an as reported basis. In reality, it's a $7 a year earnings business. That is mind-blowingly different. We talk about a lot when we do these uniform accounting webinars of companies where we have a negative versus positive issue in terms of EPS. We've got a company like, let's say you've got a company like Salesforce.com, right? That because they have a lot of R&D investment and because they have a lot of stock option expense, right? Investment and financing activities that are running through the operating statement, as reported EPS basically makes it look like it's a negative plan. But in reality, when you look at it from a flip side and you actually adjust for those on an EPS basis, you see a positive EPS. This is even more powerful than that because on an as reported basis, you've got a company that looks like it's actually barely generating any money on an operating basis, and it's a real operating business when it's actually throwing off tons of money. Why? Well, if we look, we can actually see why on the impact of adjustments tab. We can see this company has huge distortions in terms of special items, right? One-time charges that are artificially deflating EPS. But by the way, that have been deflating EPS for multiple years. Last year, it was actually a 30 cent EPS in 2018. We also got amortization expense, interest expense, minority interest expense. We got a bunch of different distortions that are causing this company to have misrepresented profitability on an as-reported basis. And because of that, you look at McKesson and you see low margins and low EPS, and you go, yeah, it's a bad business. Let's walk away from it. In reality, what you can see is it's actually a phenomenally profitable business. Now, what's going on here is there's a lot of volatility in terms of future returns, intuitively because of what's going on right now with everything around the coronavirus, and how that's disrupting, quite frankly, a lot of the normal drugs that they push out into the marketplace, right? And also, it has to deal with them having to settle some opioid issues in terms of, lawsuits, etc. But all of a sudden, what we can see with McKesson here is, hey, we can at least see that it's a high return business, and we can start to understand what's really going on, which we wouldn't even understand if we looked at the as reported metrics. And so that just gives you context about the kind of insights that you can see and the kind of completely incorrect data you get when you look at as reported data as opposed to the true uniform accounting data, and how looking at it can completely change and revolutionize your investing process.
Valens Research, the world's leading source for uniform financial analytics.